Hello, everyone. This is Professor Jacob Gold, and I want to thank you for joining me today for this 2024 annual outlook. We call it the Fed, from foe to friend. In today's presentation, I hope to give you a macro view of where we see the economy heading in 2024. Three main themes that we see in 2024 is one, the Fed goes from foe to friend. Two, the economy begins to cool and we start to enter into what we call a soft landing. And then three, market volatility can provide some opportunities for long-term investors. Let's go into a little bit more depth of what those three themes are all about. The first, we recognize that up until 2023, as the Federal Reserve began to raise interest rates in response to high inflation, that was a major headwind for the markets and the economy. What we do recognize is that July of 2023, the Federal Reserve stopped raising rates and actually recently even announced that they may begin to lower rates sometime in 2024. As we begin to see the prospect of the Federal Reserve lowering rates, not only will we see that as an opportunity for equities, but bond prices go up when interest rates come down. So now the Federal Reserve could be actually in a place where it could be helping the stock market and bond market going forward for a period of time. If we take a look at this, this gives you that idea of the fact that the Federal Reserve was raising rates beginning in March of 2022. And then in July of 2023, they stopped, and you can really begin to see that things are starting to plateau a bit. Now, another thing that we recognize is that the number of job openings is starting to come down. We recognize that we hear many times when the Federal Reserve was raising rates to try to get inflation down, they were looking for signs that the economy would begin to soften up. And one of the big areas was in the labor market. Our labor market was red hot for a long while, as you can see in this chart. But now that we have more and more baby boomers leaving the marketplace to retire, and we see the introduction of technology, aka AI, stepping in, we begin to see that the labor market is beginning to soften. There are still more job openings than there are unemployed job seekers, but nonetheless, we are far from that disparity during the pandemic years. And this slide here with the airplane, we recognize that if we do begin to see the Federal Reserve no longer raise rates and actually begin to lower rates sometime later in 2024, that really allows consumers and businesses to assume that going forward, it's not going to be more difficult or more costly to finance various projects that a company might have or an individual trying to get into a home. Ironically enough, as interest rates have gone up, residential real estate has been quite stable, and that's mainly due to the fact that the supply side of homes is very limited. And even though we have many individuals retired, they still live in homes, and we've got the millennial generation looking to form their households. They're getting married, they're starting to have children, so there's a high demand for housing, and we haven't seen prices tick up quite like they did during the pandemic, but also with the dramatic increase in interest rates, we haven't seen real estate come down. So if we do begin to see interest rates come down in 2024, that could be some catalyst for real estate, especially in residential homes. All of these things really show that if we do experience a mild recession in 2024, it could be very well short-lived, and we recognize that once we're past that rough patch, there would be even more opportunities going forward. But we very well may see that we have a soft landing and we can avoid a recession altogether. This is an interesting slide. What this slide shows is the percentage of population that is 55 years and older versus 25 to 54 years of age. From January 2000 to September 2023, the population of people over 55 years of age increased by 75%. Or another way of looking at that 42.8 million more Americans are now 55 or older. During that same time period, those 25 to 54-year-olds, they only had an increase of 6.5%. So many times we recognize that this too added to the fact that we had a lot of job openings because these baby boomers began to retire during the pandemic years and slightly before. And we recognize that there is a big gap, a big need to fill those overall positions. What we also recognize as well is that the United States is now energy independent. We have an abundance of natural gas. We recognize that due to the conflict in Europe and in the Middle East, energy costs outside the U.S. are much higher, and that really is an advantage for American manufacturing. And so what we're seeing is there's been a big boom in new manufacturing plants here in the United States. Many manufacturers, they want to build closer to their end consumer. They want to avoid the shipping costs, and they want to get it to that end consumer as quick as possible. And on top of that, if there are cheaper energy prices, that is even more of a reason why we've seen more and more corporations invest money within their own infrastructure here in the United States. Now, with all of this being said, what we recognize is that there will surely be ongoing shifts that are taking place in the marketplace. There's a lot of noise out there, and all you have to do is turn on the TV or go to any website, and you can see the negative and the positive data points that exist in this modern time. And many times when we have drastic market movements, if an investor can focus long term, certain opportunities can present themselves. What we do recognize is that the S&P 500, its PE ratio, is somewhat elevated compared to its average price going back to 1950. The average PE ratio of the S&P 500 has been around 20. Right now, we're closer to 30, which suggests that maybe the large cap stocks, the big tech, the big multinational companies, they could be considered to be a little bit overvalued right now. Now, with that being said, the opposite is the case when we take a look at small cap stocks, international stocks, emerging market stocks. You can see here on this slide, when we take a look at that PE ratio, the light blue represents the S&P, the light blue represents the small cap 600, and then the dark purple represents the S&P 500. So you can see right now that small caps are actually undervalued, and if we do begin to see earnings pick up, we very well could see some opportunity in the small cap space. Now, as we begin to see these tectonic plates continuing to shift, we recognize that markets will move quite dramatically in the short term. I really like this slide. This slide really gives us an idea of how each year performed overall, as well as what the typical drawdown intra-year looked like. Case in point, if we take a look at 2020, we can see that in 2020, the S&P 500 was up 18.4%, but during that year, we actually saw that there was a drawdown where the markets at one time were down 33.9%. That was as we were entering into the pandemic. Many times the markets don't end at the low point for the year. And just because there can be a short period of time where there's been some major drag doesn't necessarily mean that the markets can't bounce back and actually end up the year higher. My point of this slide is to recognize that as investors, there is so much noise out there that we want to be well diversified, and we don't want to give up on our portfolios when there is a short-term setback for and whatever the reason may be, whether it's geopolitical, whether it's related to interest rates or inflation, or earnings. We recognize that if we stay focused long term, the risk over time is manageable. It's when individuals are trying to jump in and out of the markets and are trying to read the tea leaves that many times they end up timing it poorly and either miss out on opportunities or lock in heavy losses. This gives you an idea as well of the 10-year interest rate. We can see that going forward past 2020, that 10-year interest rate has increased over the last several years, but we do feel that it is going to begin to plateau here, especially given the narrative from the Federal Reserve that they may begin to lower rates the second half of 2024. As I mentioned earlier in this presentation, when interest rates go down, bond prices go up. So even though the last couple of years it seems like tech has been the big driving force of growth, a diversified portfolio didn't see all the sizzle that a portfolio that would be mainly focused in large cap growth would have received. But I do feel going forward, as things continue to normalize, the power of diversification is going to really help long-term investors, because maybe we begin to see upside in stocks on all levels, especially in that small cap arena, but also perhaps pricing increase of bonds as interest rates have come down. Now, that is assuming that things are on the up and up, but we also recognize that there is a lot of geopolitical tragedy out there. We've got the war in Ukraine, we've got the wars going on in the Middle East, and this slide gives you an idea of how the stock market reacts to a war or crisis in the short term. So you can see here that when we have a one day where, like September 11th, in one day the markets were down 4.9%. 1 month later, the markets were positive. Of course, then a year later, the markets were down. But if we take a look at Brexit, we can see it as it was announced, it was down 3.6%, but 12 months later, it was up 17.8%. Or if you remember back in 1995, the Oklahoma City bombing, when that first happened, we saw the markets take a step back, but then a year later, the markets were up over 30%. My point of this slide is to not make drastic moves to one's portfolio after a major reaction to a war or crisis. As tragic as it is, we want to stay focused long term, and in many cases, that is the most prudent strategy going forward. This has just been a short little economic perspective from Cetera Investment Management and myself, Professor Jacob Gold. We really hope that you stay with us throughout the year. I plan on doing a presentation similar to this every quarter to give my clients and my students and the public our insights of what's going on economically. We also have a monthly podcast, and that podcast title is Finance Roundtable Podcast. You can listen to it on Spotify, Apple Podcasts, and soon to be, we're going to be videoing that podcast and uploading those episodes to YouTube. Here at Jacob Gold & Associates, we're trying our best to stay in front of our clients, provide you economic updates, but also teach you about investment themes and just be holding your hand through this very volatile time period. At any time, if you have any questions for us, feel free to give us a call at 480-998-4653 or look at us online at jacobgold.com. Thank you for watching and hope you have a wonderful day.